Welcome back to Difference HD. In this video, we will be discussing the difference between cryptocurrency and stocks. What is cryptocurrency? Cryptocurrency is a form of digital or virtual currency that relies on cryptographic technology for security. Unlike traditional currencies issued by governments, also called fiat money, cryptocurrencies operate on decentralized systems, most commonly on blockchain technology. Bitcoin, the first cryptocurrency, was introduced in 2009 by a pseudonymous developer named Satoshi Nakamoto. Since then, thousands of cryptocurrencies, such as Ethereum, Litecoin, and Dogecoin, have entered the market. The central appeal of cryptocurrencies lies in their decentralized nature, anonymity, and potential for high returns. Transactions occur peer-to-peer without the need for a centralized authority, like a bank or government. Cryptocurrencies are stored in digital wallets, and all transactions are recorded on a transparent, immutable ledger called the blockchain. This technology ensures trust and security in the system. While it holds the promise of revolutionizing the global financial system, cryptocurrency remains highly volatile, speculative, and subject to regulatory scrutiny in various countries. What is stocks? Stocks, also known as equities, represent ownership shares in a publicly traded company. When an individual purchases a stock, they effectively become a part owner of that company, entitled to a portion of the profits, dividends, and any appreciation in stock value. Stockholders also have the right to vote on important corporate decisions, such as the appointment of board members. The stock market is regulated by government agencies, such as the Securities and Exchange Commission, SEC, in the United States. Stocks are traded on public exchanges like the New York Stock Exchange, NYSE, or the Nasdaq. Investors can choose between common and preferred stocks, and trading can be done through brokers or online platforms. Stock investment is a time-tested way to build wealth, often used in retirement portfolios and long-term investment strategies. However, like any investment, stocks carry risk, and their value is influenced by market conditions, company performance, and broader economic factors. 12 differences between cryptocurrency and stocks. 1. Nature of the asset. Cryptocurrencies are digital assets that exist only in electronic form. They are not backed by any physical commodities or government entities. Most cryptocurrencies operate as decentralized mediums of exchange or stores of value, though some are also designed to support smart contracts and decentralized applications. Stocks are securities that represent a share of ownership in a company. They are legal, regulated financial instruments traded on centralized exchanges. A stock's value is linked to the company's performance, revenue, market conditions, and investor sentiment. 2. Regulation. The crypto market is largely unregulated in many parts of the world, although some countries have started implementing legal frameworks to govern its use. Because of its decentralized structure, it operates outside of traditional financial regulations, which can be a double-edged sword, providing freedom but also risk. Stocks are heavily regulated by government agencies to ensure fair practices, transparency, and investor protection. Regulatory bodies such as the SEC require companies to disclose financial information regularly, which increases transparency and reduces fraud. 3. Market maturity. The cryptocurrency market is relatively new, having emerged in the last decade. As a result, it is still evolving, with many new tokens and technologies being introduced. This lack of maturity contributes to its high volatility and speculative nature. Stocks have been around for centuries and are a cornerstone of modern investing. The market is well established, with a long track record of historical data, investor trust, and regulatory frameworks that support stability and predictability. 4. Volatility. Cryptocurrencies are notorious for their price volatility. It's not uncommon to see daily price swings of 10% or more. This makes them attractive to short-term traders but risky for conservative investors. Stocks also experience price fluctuations, but they are generally less volatile than cryptocurrencies. While individual stocks can show sharp movements, broad stock indices like the S&P 500 are more stable over time. 5. Trading hours. The cryptocurrency market operates 24/7, including weekends and holidays. This allows traders and investors to buy, sell, or exchange crypto assets at any time, offering unmatched flexibility. Stock markets have set trading hours, typically aligned with business hours on weekdays. For example, the NYSE operates from 9:30 a.m. to 4 p.m. ET, Monday through Friday. After-hours and pre-market trading are available, but with lower liquidity and higher risk. 6. Ownership and custody. Cryptocurrency ownership is managed through digital wallets secured by private keys. Users are fully responsible for safeguarding their assets, as losing the private key can mean losing access to funds permanently. Stocks are typically held in brokerage accounts. Custody is managed by financial institutions, and there are systems in place to recover accounts in case of theft, fraud, or loss. Ownership records are stored and maintained through centralized clearinghouses. 7. Market manipulation. The relatively low regulation and liquidity in crypto markets make them more vulnerable to market manipulation. Pump and dump schemes, rug pulls, and influencer-driven hype are common risks in the space. While manipulation can still occur in stock markets, it is less frequent due to stringent regulations and oversight. Insider trading and fraudulent activities are closely monitored and punishable by law. 8. Underlying value. Many cryptocurrencies lack intrinsic value. Their worth is often driven by supply and demand dynamics, investor sentiment, and utility in specific blockchain ecosystems. Some cryptos have real use cases, but others are purely speculative. Stocks derive value from the performance of the underlying business. Revenue, earnings, assets, liabilities, and future prospects directly impact a company's stock price. Investors can analyze financial reports and company fundamentals to assess value. 9. Fundamental analysis. Evaluating cryptocurrencies using traditional financial analysis is difficult. Most crypto projects are startups without steady revenue, balance sheets, or profits. Analysts must instead assess factors like technology, use case, adoption, tokenomics, and community support. Stocks are well suited for fundamental analysis. Investors can assess balance sheets, income statements, profit margins, and other key financial indicators. This enables more grounded investment decisions based on company health and performance. 10. Dividends and income. Most cryptocurrencies do not generate income. However, some allow users to earn rewards through staking, yield farming, or lending, though these carry risk and are not guaranteed. Many established companies pay dividends to shareholders as a form of profit sharing. Dividend-paying stocks can be an excellent source of passive income and are often favored in long-term investment strategies. 11. Use cases and utility. Cryptos are not just investment assets. They can serve as currencies, platforms for decentralized applications, dApps, digital identity tools, and more. Some are used in DeFi, decentralized finance, NFTs, gaming, and metaverse environments. Stocks have a singular purpose: to provide ownership in a company. Their utility is primarily tied to capital appreciation and dividend income. They do not offer functionality beyond traditional financial investment. 12. Accessibility and entry barrier. Crypto markets are open to anyone with internet access and a smartphone or computer. There's no need for a bank account or financial advisor, making it highly inclusive and accessible. Although stock investing has become more accessible in recent years through apps and commission-free platforms, it still typically requires a brokerage account, personal identification, and sometimes a minimum deposit. Regulatory and geographic barriers may also apply. Conclusion. In summary, both cryptocurrencies and stocks serve as investment vehicles but differ significantly in structure, regulation, and risk. Stocks are time-tested, regulated, and supported by underlying business value. They're ideal for investors seeking steady growth and income through dividends. Cryptocurrencies, on the other hand, represent a bold new frontier in finance, offering high returns, decentralization, and technological innovation, but also high volatility and risk. Your choice between the two will depend on your financial goals, risk tolerance, and investment knowledge. Many modern investors even consider combining both in a diversified portfolio to balance innovation with stability. If you enjoyed this video and found it helpful, please like the video and subscribe to our channel. Your support motivates us to create more educational content like this in the future. Thank you for watching.